There is a quote you have probably heard 100 times. Maybe you've read it in a finance book, seen it in a tweet, or had a well-meaning friend say it to you like it was the final answer to every financial question you have ever had. The quote goes like this: "The stock market is a device for transferring money from the impatient to the patient," by Warren Buffett. And here's the thing. He's right. He has been right for 60 years. He built one of the greatest fortunes in human history on the back of that philosophy, and almost nobody argues with it. So why is this video called what it's called? Because there is a version of Warren Buffett's advice that is being passed around in 2026, repeated on Reddit forums, whispered across dinner tables, shared in investing comment sections. That is not actually what Buffett does. And if you follow that version, there is a real chance it quietly costs you money. Not because the man is wrong, but because the advice got lost in translation somewhere between Omaha and your brokerage account. My name is Jonas, and I have a genuinely unhealthy relationship with other people's finances. Why some people build wealth almost by accident, while others stay stuck, no matter what they earn, is basically all I think about. If the idea that following the world's most famous investor could quietly hurt your returns makes you want to close the video, stay with me. Because the argument I'm making is not that Buffett is wrong, it's that you are not Buffett. And that difference matters more than almost anyone is willing to say out loud. Let's start with the piece of advice that gets quoted the most. Buy and hold. Buy great companies at fair prices. Hold them for a long time. Let compounding do the work. Ignore the noise. This is the version of Buffett most people walk away with, and on the surface, it is genuinely good advice. The problem is the gap between what that advice means for Buffett and what it means for you. Buffett does not need his money for anything. He is 95 years old, has no mortgage, no tuition bills, no emergency that requires liquidating a position at the wrong time. His time horizon is functionally infinite, and his ability to hold through a 50% drawdown without flinching is not a personality trait. It is a structural advantage that comes from having so much money that a market crash is an opportunity, not a threat. For most people listening to this, that is not your reality. You have a rent payment due. You have a car that might need replacing. You have a retirement timeline that is not infinite. It ends on a specific date, and the sequence of returns you experience in the years around that date matters enormously. The same buy and hold philosophy that made Buffett $140 billion can, under the wrong conditions, leave a real person in a genuinely difficult position if they bought at the wrong price and needed the money at the wrong time. Here is the part of the story almost nobody tells you. Right now, in 2026, Berkshire Hathaway, the company Buffett built, is sitting on nearly $400 billion in cash, not invested in the stock market, sitting in Treasury bills and cash equivalents. $400 billion, the largest cash position in the company's entire history. Buffett has been a net seller of stocks for more than 12 consecutive quarters, selling more than he has bought for over 3 years straight. He sold down his Apple position by more than half. He trimmed Bank of America significantly. He has essentially been quietly exiting the stock market while telling retail investors on television to buy and hold index funds. Now, to be completely fair, Buffett himself says he is not predicting a crash. He says the cash is simply there because he cannot find anything worth buying at today's prices. And that distinction matters. He is not saying get out of the market. He is saying the prices are not compelling enough for him to deploy capital aggressively right now. But think about what that means. The most celebrated value investor in history, with a 60-year track record of knowing when stocks are cheap, cannot find anything worth buying at all for 3 years straight. The reason he cannot find anything worth buying is the same reason that should make any retail investor at least pause before blindly dollar-cost averaging into the S&P 500, and assuming the historical average returns will simply arrive on schedule. Here is the number that explains everything. The Shiller CAPE ratio, a measure of stock market valuation that averages 10 years of inflation-adjusted earnings, is currently sitting at around 41.8. Its long-run historical average is 17.3. That means the market is trading at more than twice its historical average valuation. The only time it has been higher in over 140 years of data was December 1999, right before the dot-com crash wiped out roughly half the market's value. This does not mean a crash is coming tomorrow. Markets can stay expensive for years. The 1990s proved that. What the data does say, consistently, is that when you buy at a CAPE of 41, your expected returns over the following 10 years are significantly lower than the historical average. Research from asset management firm Invesco using this same metric found that starting at current valuations has historically been associated with muted or even negative real returns over the subsequent decade. So when a 25-year-old is told, just buy the index fund and hold it forever, the historical data backing that advice was built on decades that included buying at valuations of 10, 12, 15, not 41. The advice is not wrong in principle, but the expected return attached to it in 2026 looks meaningfully different than the expected return people are picturing in their heads. And here is the third piece that almost never makes the conversation. Buffett's actual advice for regular investors, the advice he has given repeatedly in shareholder letters, is not to pick stocks the way he picks stocks. It is to buy a low-cost S&P 500 index fund and leave it alone. He said it plainly. Most investors will do better with an index fund than they will trying to do what I do. And he is right about that too. But this is where the lost-in-translation problem becomes real. People hear Buffett say, buy an index fund, and then they also hear Buffett say, buy great businesses at fair prices and hold forever. And they try to do both at the same time. They buy individual stocks they do not fully understand, hold them through losses they cannot afford, and justify it by saying they are doing what Buffett does. They are not doing what Buffett does. Buffett does this full-time, with a team of analysts, 60 years of pattern recognition, and the ability to wait years for a single opportunity without the pressure of needing liquidity. The version of Buffett that retail investors are trying to replicate does not exist in the way they think it does. So where does this leave you practically? First, the index fund advice is still the right call for most people, not because the market is cheap right now, it is not, but because the alternative of trying to pick individual stocks is statistically worse for almost everyone who tries it. The advice survives even if the expected returns look lower over the next decade than they did over the last one. Second, valuations matter for your expectations, even if they do not change your strategy. If you are expecting the S&P to return 10% annually for the next 10 years based on its long-run average, and the market is currently at a CAPE of 41, you may want to adjust that expectation downward, not to panic, but to plan honestly. Lower expected returns from stocks might mean you need to save more, work slightly longer, or hold a more diversified portfolio than 100% U.S. equities. Third, and this is the part Buffett himself actually agrees with, the most dangerous version of his advice is not the advice itself. It is the confidence it creates, the idea that you understand what you own, that you can hold it through anything, that you have the temperament of the world's most patient investor, when in reality, most people sell at the bottom and buy at the top, not because they are foolish, but because fear and greed are real. And they are more powerful than any investing philosophy when your actual money is on the line. Buffett himself said it at Berkshire's 2026 annual meeting. We have never had people in a more gambling mood than now. The man who built a fortune on patience is watching the market turn into a casino, and instead of deploying his $400 billion, he is waiting. That is not market timing. That is discipline. And it is a very different thing from what most people are doing when they call themselves Buffett investors. The advice is not the problem. The gap between the advice and the reality of following it, that is what costs people money. Run your own numbers, know what you own, know what you expect, and be honest about whether you can actually do what Buffett does, or whether the index fund, at a realistic expected return, is the version of this that actually works for your life.